So to kind of summarize this tailwind chart, while stocks maybe aren't as expensive, it's still better to buy them when they're at a reasonable value than it is when they're very expensive.
Oh, yeah.
So this is kind of a tailwind to the economy. Inflation is headed down, maybe not as quickly as we had hoped or expected, given the massive rate increases that the Fed has made. But we did come from a high of 9.1 to 6.5, I think. So it's trending in the right direction.
Yep.
And then China reopening, huge. It's the world's second largest economy. A lot of our supply chain issues were the result of that. In the short term, obviously, China, I think they've got 1 million people with the pandemic right now. So it's going to be painful for them, but clearly in the near term is great for the world that China reopens.
And so we talk a lot about your starting point matters. And what I mean by that is when you look at valuations, and it gets back to if you feel like they're fair, they're cheap, or they're pricey, if they tend to be a little bit lower in your estimation, that really sets the stage for some above average future years growth, especially if you've got time on your side and you're willing to look out, say 5-10 years. Your starting point does really matter. And it's not only stocks, but if you look at the bond side, the 10-year Treasury, notice how yields, kind of back to what JT was saying about what the Fed had done last year with all the rate hikes. But notice even when you look out at longer dated bonds, maybe something in the 5 to 7 year average maturity, in this case we're even going out to 10, we were about 1.5% roughly on the 10-year Treasury at the beginning of 2022. Notice how we're now, at the beginning of this year, we're at 3.8 roughly. We have settled back more into that 3.5, 3.6 range. But that is a tremendous jump in what you can get on a bond in terms of income. And so once again, if you're looking forward, there's been a lot of pain in the bond markets this past year. But going forward, your yield is much better. And so back to Dennis's margin of safety, even if rates do continue to rise, you've got a better starting yield and more insulation going forward. And we don't think we're going to see a repeat of what happened last year. Bonds could still be under pressure for a while if rates do continue to rise, but not nearly in the fashion that we saw last year. So we think bonds are kind of back and at least a better tool in the portfolio. So we're kind of excited about that. And we as, I think, humans focus a lot on the absolutes, whether things are good or whether they're bad. And really, as an investor, I think it's more about whether things are getting better or they're getting worse.
Old industry value stocks here in the U.S., they have some of the same compelling multiples. And those were the quality companies that Dennis was talking about earlier, where there's an opportunity to start building positions right now, for the next 5 or 10 years or so. On the bond side, you went from a U.S. 10-year Treasury at 1.5%. End of the year, about 3.8%. It's actually retraced to about 3.5% so far this month. However, if when we're constructing 60-40 portfolios or 75-25s, the bond piece is a huge piece of that return. And so when we're projecting out 5% returns, 7% returns for the financial plans we do, it's a lot easier to get that return if you can get yields in the 3, 4, 5% range on bonds. Makes our jobs a little bit easier than when yields were at 1 and we had to, put other pieces on the field to increase that return over the last probably 5, really since I've been at Stearns, we've been underweight bonds. And so I think this is the first time in the last 5 or 6 years where we're having a real conversation about whether we're going to return to, I guess, a more normalized portfolio, but adding more fixed income, more bonds there, which also gives more protection on the downside when you're at 3, 4, 5% on bonds versus at 1.5% bonds. So see it on the chart, the blue line is already peaking down. You're looking at leading indicators like producer price index. That's the business side of consumer price index. It's coming down quite a bit. Lumber prices are down, auto sale, our used cars are down. I think the Zillow rent index is down. So all these are leading indicators of where inflation is going to go. And I think the biggest predictor is just the money supply. We had a huge growth in the money supply during the pandemic through all the programs that the government instituted to get cash in consumers' hands. Over the last year, you've seen that go negative. And so I think that all these are indicating that over the next 6 to 9 months, we'll get kind of more towards normal inflation rates. And the stock market behaves a lot better at 2 to 4% inflation than it does at 4% plus.
You know, we're at 3.2% now, so we're getting back, you know, to where we were.
It's below the 50-year average, right? So if you just take the last 90 days and assume that that's going to continue for the rest of the year, we'd have a 3.2% inflation rate. That's not what you're hearing from the headlines, is it? It's all about the 6.5% or 7%. But inflation has come down. We're already below average inflation. So maybe the bottom line on inflation, there was a lot of headlines, a lot of discussion a couple of years ago about inflation being transitory, and people got mocked because it clearly was not transitory in the way they meant it. But transitory in a 2-year frame of reference seems quite likely at this point.
I'm always a fan of buying quality stocks when they're selling at a discount, and I think we're in that range. If the market has another leg down, we'll certainly be in that range where I would want to buy stock, high quality stocks. So that would be my bet over the next 3 to 5 years.
And so I think investing in quality companies, whether they're here or abroad, is usually a good potential return over the long term, over a multi-year period, really. Again, in the short term, we do not know what the stock market's going to do, but over the long term, if you're investing in quality balance sheets at reasonable valuations when you enter the stock, that usually has a good outcome for you as an investor.
Compared to 2022 at the start of the last year, the start of this year has much more compelling investment opportunities across the landscape. So whether it's stocks, bonds, international, domestic, private assets, et cetera, you know, there's much more compelling opportunities now than last year. Yeah, so generally following a recession, forward-looking stock returns are a lot better than prior to the recession because you do have that decline. You have a better entry point, better valuations to buy into stocks. I know it's not comfortable to do so. As Holly mentioned, it's one of the few assets on the planet where when stocks go on sale, you don't necessarily want to buy. But Dennis, as you often say, that the best returns in the stock market are when things go from very bad to not quite as bad. You get a real spring off the bottom, and generally the market's going to run in front of the economy. So if we look back, I don't want to turn back to the chart, but if you look back to 2009, you're actually still in an earnings recession when the market bottomed and recovered, and the economy itself didn't recover for probably another 6 months after the bottom of the market. So generally you want to start building those positions even before the recession happens or shortly into a recession and start building back into a strategic allocation. So
it seems like common sense, but again, when we were down at 1.5% starting yield, it's hard to expect good returns over the next 5 years when you start out that low. And so we started out this year around 3.6% on the 10-year. Again, over the next couple of years, over the next 5 years, according to this chart, that's probably a good barometer of a ballpark of what you should expect to earn in the bond market from that perspective. Again, this doesn't account for if we do end up with double-digit interest rates. You know, 3.6% is probably not a good starting point. But over the last, going back to 1987, so over the last 35 years, it's been a pretty good barometer. So 3.6% starting point. That's a much more attractive return. And as Dax alluded to, when you're building a diversified portfolio and your bonds are actually doing some of the heavy lifting, it's a lot easier to achieve that more material long-term return that we've been used to in most environments throughout the past 100 years.
So again, one big takeaway that I think will help the stock returns, regardless of whether we're shallow recession or how long the recession is stock returns coming off of this type of environment do tend to be above average. And it goes back to what Glenn said. The biggest stock returns are not when you go from everything sunny and bright, or everything's dark and gloomy to everything sunny and bright. It's when things go from dark and gloomy to a bit less dark and gloomy. That's your biggest stock returns in history. So again, if you wonder why, we're saying stocks are pretty interesting or getting more interesting now, those are some of the reasons. 15 years ago, there were 10 different flavors of private equity. Today, there's over 70 different types, all kinds from niche to big company to different ways that companies, buy a piece of a company, look for it to go public or be bought out by a big company. Again, it's just a very different environment. And the good news is we have a whole bunch of flavors of ice cream in that space now that a lot of our smaller portfolios can afford to get into. And so it's a question of, is it a core? Is it growth in income? How conservative do you want to be? Is it more growthy or an explore portfolio? Multi-sector private alternatives, again, is where you get one-stop shop diversification within a portfolio. We didn't even have this available for, again, smaller client accounts 5 years ago. And now we got some of the best in the country available in this category, so that's a good thing. The different things that are on this screen are probably not appropriate for everybody in the room, but some of them may be appropriate for a piece of your strategy.
Because I think sometimes when you have a year like we had last year and you've got alternatives doing really well, why not go 100% into the alts, right? And so I think it's very important for us as consumers and investors to understand that there's a different risk reward for each asset class. To your point, Dennis, it's not appropriate for many people, regardless of the profile of the investment, to be in some of these asset classes.
So your own unique circumstances, your financial roadmap, how much you're spending relative to your resources, all of that stuff bakes into which of these make sense for you. That has not changed. In fact, if anything, it's probably more true than ever.
Well, look, thanks so much for attending. We really appreciate your engagement.
Thank you all.
Yeah, and best wishes in 2023 to each of you, and hopefully a better year for the financial markets as well.